Hey, everybody, please take a minute and click subscribe to my channel if you haven't done so already. And please check out the link you see on your screen for a message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. That's the best way to support this work we're doing. We're now well into earnings season, and we've heard some from all of the big banks and most of the smaller banks at this point. And it's been a really long time since we've been able to say that Wells Fargo looks like a standout this quarter. If you look at the numbers, Wells Fargo's revenue is up 20%, and that's driven by interest income. Wells Fargo is essentially a pure savings and loan. Unlike most of the big banks that have big investment banking operations, Wells Fargo is mostly just a traditional consumer bank. So its net interest income is a big beneficiary of the Fed's interest rate increases and is up 29% year over year. You can see its net interest margin has really grown over the past year, and with the Fed recently hiking rates again and projected to do so again before the end of the year, it could get even better. Wells Fargo has also done a great job of controlling its expenses. Its non-interest expenses up just 1% year over year. Combine that with the revenue, and the results look pretty fantastic. The loan portfolio is up by 2%. Deposits are down 7% year over year. But don't read too much into that. This is kind of a natural thing because the big banks don't pay a ton of interest. I know my Wells Fargo savings account doesn't pay a lot. So a lot of consumers are looking elsewhere for higher yielding options. There are a lot of online based high yield savings accounts that are paying 4% or more in interest right now. So a lot of people are moving savings deposits away from the big banks, but not in massive numbers. So this is actually pretty okay. The bank is producing the numbers that we'd like to see from these kind of banks. Return on equity of over 11% is right on par with what you'd want to see. The bank's efficiency ratio is down significantly from last year. Remember, with efficiency, lower is better. It's a measure of how much the bank is spending to generate its revenue. 63% is not great in the context of an online bank, but as far as a big mega brick and mortar institution, this is what you want to see. Wells Fargo is making a lot of money right now and is doing a great job of returning capital to shareholders. They recently announced a brand new $30 billion stock buyback plan. That represents like 15% of Wells Fargo's total market cap. This is an aggressive pace of buybacks. It one shows that management is prioritizing buybacks. It gave a dividend increase, but it was relatively modest compared to that $30 billion buyback plan. So that says that management thinks that the stock is very attractively valued right now if it wants to spend that much money on buybacks. And I quite frankly agree. Wells Fargo is trading for a pretty good valuation, but we'll get to that in just a second. It's not all great news. There are some concerns going forward. Number one, Wells Fargo is still not allowed to grow. A lot of investors don't realize this just because it happened several years ago, before the pandemic even. But the Federal Reserve penalized Wells Fargo for their infamous fake account scandal and other bad behavior by essentially prohibiting them from growing. Their assets are capped at what they were about 5 years ago, and it can't grow anymore. And Wells Fargo executives expect this to remain in place until at least 2024. So they're not allowed to grow. That's a big disadvantage over other banks. Wells Fargo, on one hand, is a big beneficiary of rising interest rates because it is essentially a pure consumer bank. But on the other hand, that also makes it more susceptible to recessions and people not able to pay their bills. Now, so far, we're not seeing anything too alarming. Net charge-offs are up significantly from the second quarter of a year ago, but are still consistent with pre-COVID levels. This is more just a normalization than a spike, and the bank still has a lot of money in reserves. Just to put it in perspective, the net charge-off rate currently is 0.32% of the total loan portfolio. The bank has 1.56% of its loan portfolio in reserves right now, more than enough wiggle room even if loan losses spike a little bit higher. The other concerning thing is commercial real estate. Wells Fargo is a big commercial real estate lender, and there are a lot of concerns with that right now, particularly in the office sector. So office properties are, quite frankly, worth a lot less than they were a few years ago. And a lot of these were financed with very low interest rate debt that is about to come due. The landlords aren't going to be able to pay them. They're not going to be able to refinance them. And that's a big concern. Office is roughly 22% of Wells Fargo's commercial real estate loans. about 3% of its total loan portfolio. It has better office loan quality than most, but this is still a concern going forward. But just kind of breaking it all down, Wells Fargo is a big beneficiary of rising interest rates, which should serve it well for years to come, especially if we get a soft landing, as the Fed puts it, meaning we're able to avoid a bad recession, which it looks more and more like we're going to be able to do. Wells Fargo trades for just over its book value, about 1.04 times book value. That's higher than it was a little while ago because of the recent rally in the market since the banking crisis earlier this year, but is way below the bank's historic average. If you look before the pandemic, about a 1.6 multiple of price to book is more than norm for Wells Fargo. I'm not saying it's going to get there again tomorrow, but this is a very high quality institution that is a beneficiary of current market conditions and is making all the right moves to move past the bad behavior that plagued the stock for the past 5 or 6 years. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.